The news is, I guess, less exciting today, and the market is crazy, so we definitely need another market update. I'll go over some technical analysis, set up the cycle, that stuff, talk about the news. This is Brian Lewis with MMT Investing, and things just changed. So, what we have here looks like it just looks like a bear pennant here, bear pennant consolidation on this, and we're coming in from the top side. So let me take a look at. We got some good bull pennants, and we got some bear pennants in the previous cycle that we can look at just to kind of see the shape of what the next couple movements might look like. And so here's a couple good ones on the way up, and you can see that we get these breakout consolidation, breakout consolidation, breakout consolidation kind of moves here. And this is a series of bull pennants that we got on the way up before a crazy kind of reversal shape here. And that is the kind of thing that we're sort of looking for on the downside right now. And if we go back to the previous cycle, what we can see here is we get our double top, and then we get some back tests of the outer tangent line here, and then we get a series of these bear pennants, down, bear pennant, down, bear pennant, down, and then we get this wild shape here where the volatility and the volume kicks, and this is a dead cat bounce. And then we got a nasty, nasty sell-off after the dead cat bounce, back test, and another nasty sell-off. So if this type of cycle is to repeat, just looking for this kind of shape where it rips down and then kind of fights back up, rips down, fights back up, rips down, fights back up. And you get a pretty steady angle down to the dead cat along those shapes. So we should be able to take a look and see the angle that we're headed upon here, and we'll see if we're actually getting bearish or not, because the MACD is still on the bullish side, and so definitely don't want to get ahead of ourselves on the bear side until we actually see everything go bearish. So those are the shapes, sort of bear pennant shapes that I would be expecting here, and we got a little bit of different action than the last cycle across the sort of trend lines. Here, let me zoom out and take a look at these trend lines. So off the top of the bubble, we get these inside tangent lines here that are part of the bull trap crossover. And then here we get another tangent, and this comes off the corner of the previous bull trap. So it comes off the corner of the previous bull trap here. And then we get this crossover on this one. And so this third outer tangent here, this red line, is the same kind of thing. It just kind of chops the peaks on this outer edge here to get to here, and this one is chopping the peaks on this outer edge here. And this red tangent would be pointing way out, like 2 months from now, if we do happen to get another repeat of this pattern, if we get another kind of crossover. This would kind of come in sort of a swinging area on that crossover. Who knows, 3 months away, something like that. So that's the outer tangents, and then let's look at these support trend lines. So these yellow lines are not horizontal support lines. These are angled tangent lines that come off of the bottom of previous crashes, and they set up a support, I guess this direction, for long-term trend lines. And so this is off the bottom of the 2018. It's the 2018 Volmageddon was like the top at the beginning of 2018, but this is a line off the bottom crash of 2018, and this is a wave. This is one wave that's like 2 years, and that wave terminates here, and this yellow line is the bull market support tangent of that entire wave. And then once you terminate the wave here, then that tangent line is gone, that wave is gone, and then we get down into the next wave here. And this is a longer wave from the 2008 financial crisis. And so we've already gotten the same kind of action. You break, back test, get up, we get a double top test, and then same thing here, break it back, get up, and then we do a double top here. So this looks like a repeat of the same kind of pattern. And this is a 12-year trend line from the bottom of the financial crisis. And we're looking to see if this right here is terminating this tangent line and we're going to get out of here, or if we're going to get a high bounce and get more action along this tangent. So we'll take a look at the MACD and see where we are on the moves and try to get this thing out early enough for people to see it. It's been really slow uploading these videos. My last one took like 3 hours to upload. So yeah, what I woke up to this morning was just kind of this consolidation shape. But we're already starting to get a rip down now, and I think the market is going to open down here somewhere, and we'll just be looking for another kind of consolidation reversal area here. Should get another kind of bottom and bounce similar to these from the looks of where it's starting now. And once we get the shape of these kind of rip and consolidations, this is a steeper angle than I was thinking, but because this angle here is much, if you go to the previous cycle, kind of the angle off the middle top here is much less steep than this angle out here, down off the second top. And so this steepness being similar to this steepness, that looks too steep. And you can see the angle of kind of the red trend line here. And this trend line doesn't exist yet. I'll work on that later. Yeah, okay, so let's take a look at the MACDs. I'm on the hourly here. So this hourly MACD is not incredibly informative long term, but it's really helpful for the day trading outlook. And right now we are squarely on the bear side of this thing, and we are wobbling and getting more bearish. This is super, super bearish on open and on day trading here, because we're all the way down on the bear side, and we're not only trending on the bear side, we're turning down and getting lower peaks on the bear side. This is super, super bearish for today's trading. And let's hop out to some other candlesticks over here. So if we hop out to the dailies, we can get a look at our cycle. And so this, okay, we're getting a pretty aggressive momentum switch here, and we already got our crossover, and this looks like it's getting wider. So that is a bearish signal, but we're not in bear territory right now. So what I mean by that is these lines are both up here on the bull side of the chart above the 0 line. And so if this thing gets a high middle bounce, you will see me get very bullish. But for right now, it's headed down, and the short term is bearish. So this is short term bearish, and long term or like medium term, can't really tell. So we don't know. So if this goes, if this red line gets down below the 0 line here, that is bear territory. And then we need to see if it stays bearish or if it gets back to bullish. So right now we are still bullish. We're not in a bullish trend, but we're still on the bullish side of the chart, and we need to see if we stay on the bullish side of the chart or not. So basically, just a crossover here would be very bearish, and that would be a huge rip down to get to that point. And a bounce on the bull side at this 0 line or anywhere at the 0 line or above it would be a big bull rally indicator, and it should be a V bottom. In either case, we should get a pretty sharp V bottom where we bounce, and that is going to be a major, major indicator of whether we're getting sort of a reversal back up to this kind of trend line here. So I would say if we get a high bounce here and go up, we're probably trending back up to this yellow line, and we haven't terminated it yet. But if we switch down to the bear side here and get a low bounce, that's probably going to be a dead cat bounce in a downward longer rip. And so it looks like the bull and the bear case right now are looking for a little bit of a move down, and we don't know where the bottom's going to be or what it's going to look like. And so that's the medium term. So the medium term is trending bearish, but it's not a bear signal yet. And let's go out to the weekly. And this is just bearish. I mean, we're like the outlook for the rest of the year here is that the stock market is just ugly. And I mean, in order to get into a long-term multi-year bull, we got to get back up here onto this side. And I would expect a little more activity on the bear side before we can get out of here. And this could be activity, bear side activity down the whole backside of the bubble over the next like 2 or 3 years. And we could get little bits of bull side in the long term. But this is just kind of an outlook of where we are on the year-to-year basis. And this thing is not that useful as like a leading indicator. It just kind of tells you where you are. And I mean, obviously, we just had one of the biggest rips down in the history of the stock market. So obviously, that's kind of bearish. And it did pull the long term down here. And then if we go back leading into it, I mean, you can see how bullish the stock market has been since the financial crisis. There's just little dips. See, here's the financial crisis. The financial crisis got crazy bearish at the end, and the beginning of the housing bubble here wasn't quite as bearish. But we got crazy bearish right at the beginning of this rip. And so it is possible to come back out of it faster. And it is also possible to keep going that way. So the long term, you can see after the financial crisis, you know, it's like 90% of the activity is on the bull side. And that's our huge bull run, that whatever it is, 10 or 12 year bull run, is all this bull activity on this side. And it just keeps going up. And you get these little tiny, I mean, these huge bear side moves down here are just these little dips here. And it's still just this long bull market trend line. And you can see our trend lines here. So this is that super long 12-year line off the financial crisis that supports this entire bull run. And that's the line that we're interacting on now. And if we get in here to this Volmageddon bottom, that line we've already terminated on the S&P, and we've gotten down to this line. And then the next line is, I don't have the whole line drawn in on this chart, but it's somewhere down here. And this is like a 40-year long bull market trend line off the 1982 bottom where the entire everything bubble started. It starts way back there, and the dot-com and housing bubble are just part of the everything bubble. And so that is really like the floor of the entire everything bubble. And this kind of area around 12 somewhere could be a downward target towards the end of whatever the 2-year cycle or something like that. If we get down and completely reverse out of this everything bubble and then start again. And I guess I could mention some other bubbles. So like these trend lines, you can land on them and just stick to them. Like the Black Monday crash just landed on this Volcker line. It just landed on it and continued. So you can just straight land on the line and just continue. Or like the Nikkei bubble, the Nikkei bubble reacted all over the floor line, and then it swung underneath, and it went into a bear market for like 20 years underneath the floor of the Nikkei bubble line. So that's possible. Or like the Great Depression, like dipped underneath the floor line, and then it came off at a pretty steep angle on a new bull market trend line out after the Great Depression. So what you do at the end of a bubble is pretty hard to predict. But it's pretty easy to predict that when you start unwinding the bubble, you're just going to be interacting on these bull market lines, and then when you terminate one, you're going to be heading down to the next one. And so that's kind of the outlook for this month, is see if we terminate this line And if we do, we can get a significant move down right now. And we'll see that on the MACD. We'll get bearish on like the daily candles on the MACD if we're terminating this line. And if we're not terminating this line, we'll stay bullish on the daily candle MACD. And we'll get back up here and do some more work on this thing. And that's the look over the next month, sort of. And the day trading looks pretty bearish to me, and we're already getting these rips to the downside pre-market. So I don't think anyone's going to have time to get short. This morning. I think we're gonna get a pretty good rip to open, and let's get in on some tighter candles, maybe like 10 minutes or something. And let's check out these Bollinger Bands too, because these are super useful. If you get in tight on the Bollinger Bands, you can see right now. So if you stick to the bottom side of the Bollinger Bands, that's very bearish, and if you stick to the top side of the Bollinger Bands, that's very bullish. So we've on the tight trading here, we've kind of alternating between bearish and bullish. So that's not a very good long signal, but recently we've gotten more bear side activity. And then this right here is just a crazy consolidation zone where we haven't been sticking to either side. We've just been bouncing edge to edge to edge to edge. And that's a consolidation area. And if you're in a bear trend, that will be a bear pennant to the downside. And oh yeah, I was just on the Grok Trade channel, and he was doing some bear pennants and some bear consolidation zones. I left him a comment and said I would give him a shout out here. So he's drawing this entire zone. He's calling this whole zone over here a bear flag, where I can't see it on the 10-minute candles. I'll get out and do that. Let's get out now and let's go back to hourlies, and I'll draw that kind of stuff that he was talking about. So we have this general kind of bull market trend consolidation zone, and then we get outside of that consolidation zone, and we start back testing it and wedging outside of it. And so he's calling this a huge bear flag when you get this decreasing volume, decreasing volatility, and you get outside of the consolidation zone. And then it kind of sets up another consolidation zone here, and with more decreasing volume and more decreasing volatility. And then you get outside of that zone. So that's like a bear flag, or on top of a bear flag. And then we get this bear pennant shape down here. So this is just kind of stacked bear shapes that he was talking about on his channel. And he's wondering if we get a rip or kind of a bounce. And the technical analysis people are talking about this two options a lot. I was looking at Game of Trades, and he was talking about the same kind of thing. Or like the Elliott wave options were previously, like back in this area, the Elliott wave guys were saying, you know, we could see like a huge C wave correction here. And the farther it's trended over, they're like, well, we'll see what we get, because now it's weird. So it is really hard to predict from technical analysis point of view how deep we're going to go and what angle. Looks pretty steep. It looks steeper than I was expecting right now, and it looks a little more bearish than I was expecting. But we are outside of all of these wedge consolidation zones, and now we have gotten a big change here. So you see this volume here. This volume and the volatility kick at the same time as going bearish on the short and intermediate is this is a break. It's a break of this whole trend pattern, and we have switched into bearish activity with higher volatility. And so I just did a video on how to go long volatility without getting hit, without getting hit by the negative carry on like the TVIX or something. If you hold the TVIX, because you can only kind of day trade that thing, and this is not investment advice, but you can really only day trade the TVIX. And if you hold it, like I want to go long volatility for a month or something like that from here. And so what I did is the SVXY is an inverse VIX fund, And so you can short the inverse fund, and then that negative carry, the rollovers, the compounding, all that negative math that hurts you when you hold those funds for multiple days or longer term. I just did put options shorting the inverse VIX. So I'm long volatility, but it's a trick where that negative carry math actually helps your trade, and you can hold. You don't have to hold anything. Like I just got put options against the inverse VIX. So it's the long volatility trick where I just kind of bought insurance against volatility going up, and so basically just gonna get paid on insurance if the volatility goes up, and there's a pretty good chance that it will. And then you also get all those negative carries helping you. And so my next video is going to be really, really cool because I've been trying to figure out a way to go long on oil when all these oil ETFs have that same problem. They have all this negative carry, they have the compounding, and they have contango like killing them. And we're coming up on another contango period here. It's the middle of the month, and we're going to start seeing the spot oil contracts come in on the 15th, and we're going to see contango rollovers and stuff, the 15th to the 20th. Like this whole next week is kind of the monthly negative carry zone on like the UCO, the ultra crude oil, the USO, the US oil fund. And my next video, I'm going to get into a secret where you can go long oil and have all that negative carry on your side. It's going to be really cool. And I guess the news today, not quite as interesting. Trump's tweeting about ObamaGate, and it's Obama's hypothetically charged of some crime that nobody will actually say what the crime is supposed to be. This is just a bunch of political nonsense, kind of switching into election time. Stan Druckenmiller, I did a video on Stan Druckenmiller a little while ago. He's great. He's great with all kinds of diverse positionings in different kind of commodities, and he likes going short and long in the FX markets on like against commodity currencies and stuff like that. And he does some really cool stuff that I talk about sometimes. And what he was just saying is that this is the worst overvalued market like ever. Like the values versus where the stock prices are just ridiculous right now. And he didn't say the Fed can't stop it from coming down, but he just basically said that that's not going to happen. He just put out a pretty bearish outlook on kind of fundamental valuation things. And of course, Warren Buffett is doing the same thing, stacking cash and selling stuff that he's scared of. He still loves airline stocks, and he's just piled up a ton of cash. So from the fundamental standpoint, it's no surprise that the fundamentals are bad. And of course, with the whole health situation, the fundamentals are even worse now in the lockdown. And I mean, that's no secret. But the thing is that everybody's saying that the Federal Reserve is making the fundamentals irrelevant. And I've heard a lot of people, even like macro people, saying like, yeah, the Federal Reserve can just like intervene and it can go up even with terrible fundamentals indefinitely. And that's what everyone thinks, the Fed's just pumping the market. So I've been addressing this issue quite often, and just operationally, without the whatever, the hyperbole and the hype about the Fed pumping the market, like operationally, the way that the Fed was pumping the market prior in the bull market was providing liquidity to these companies, and the companies are buying stock buybacks. And now the government has said no more stock buybacks. Like they're making it a bad word, and they're also making it illegal. If you get a bailout loan, they are going to make it illegal to do stock buybacks while you're using the bailout loan. And so that's the main buyer in the entire stock market over the last several years, like the number one buyer in the entire stock market. So yeah, like the valuations are bad here, but the number one buyer that is buying the market and getting it up to this point is gone. Like those companies buying their own shares back is gone. They don't have the fundamental ability to buy their stocks back now because of this credit contraction cycle. I haven't even mentioned the contraction cycle. So let's take a look at the length of this cycle. And the reason I'm bearish actually is none of that stuff. I'm bearish right now based on the cycle because we're in it looks like a 4-month credit contraction cycle. And I think we got kind of an early move down because of the health situation. But the general look of a credit contraction cycle is just kind of a down and a bounce and a bounce. And if you are in a bear market, it's usually lower bounces. And so just when I saw this huge rip here, I'm like, oh, okay, we're in a credit contraction cycle. And there's plenty of financial data as well that's pointing to a credit contraction cycle right now. And then all the news coming from all the lenders and the banks, the mortgage companies, the international European banks is all saying less money available. They're all the banks are getting their funds together to try to handle all these defaults that are going to come in. International companies and banks are holding all their dollars to try to pay their loans. It's hard for people to pay their loans. It's hard for individual people to pay their loans, school loans, auto loans, house loans, all that stuff. And that's what happens during a credit contraction cycle. It's just there's less money available and it's harder to pay loans. People default. And you get these shapes. You get these shapes where you get this credit contraction rip, and then you get some bouncy stuff, and you usually end down on the cycle. And then after that, it looks like we're going to be going into an expansion growth phase. And so I'm just basically bearish on this whole cycle, which looks like the middle of June or something like that. And so from the cycle perspective, I was expecting to stay on the bearish side of the daily MACD and kind of bounce down. And we didn't do that. We got all the way to the bullish side. So we're up here in what's going on territory. And a lot of the fundamental people, or the technical analysis people, are scratching their head. And from the cycle perspective, I don't know. I mean, you usually get like a clean middle bounce area, and I think we missed that. I don't know. Yeah, I don't know. I don't know about the middle bounce part of the cycle. You usually get like this kind of choppy shape and then go back down, or even chop up higher and go down at the end or something. But we just got this kind of flat dying curve. It's a really weird one. I don't have a whole lot of good comparisons. I guess if you look at the Nikkei bubble, you can see some similar stuff to this shape on the longer term timeline, but not in a one cycle, where you just kind of get up underneath this long-term tangent and just stick on it, like the Nikkei did that, just stuck on it and stuck on it and stuck on it, and then finally reversed out of there. So from a bubble and sort of long-term bull market bubble look, like this isn't that crazy to just stick to a trend line for a while. But as far as a credit contraction cycle goes, like we just didn't get that middle area that I was expecting. And we did get all the way to the bullish side, which is pretty rare. And this looks like a bear market, but we got all the way to the bull side. So, and now I don't know if it's a bear market long-term outlook, and we have to really watch these trend lines and see if we terminate them and get a bear market outlook after this cycle or not. So that's kind of the long-term bubble setup. And what are we getting now? So yeah, so this outer tangent line, it looks like we got some action on this thing. We'll probably get some action on the bottom side. And then the angle of this thing, what would it be? I don't know whether to try to start an angle from over here somewhere or from here, but that angle seems too steep, and that looks like the angle that we're on now. So I have plenty of short exposure at the moment. So I think what I'm going to be doing probably is kind of looking for spots to kind of day trade in and out of my shorts on the way down and try to figure out these angles and try to get some bounces And then, of course, if we actually get a high middle bounce on the MACD, then it's bullish, because then we're really in bull territory. So I'm just going to be very careful. I have short exposure, and I've covered a bunch of sectors and things that I'm trying to short. Shorting the Russell and shorting emerging markets because those have the highest exposure to debt risk and no bailout kind of backup. And those are already down a lot, but they do have a lot of downside risk. And then the oil prices are going up, but the oil contracts are coming up to their kind of rollover points now. So the contango risk and the long squeeze risk is on for like a week or two. I'll cover that in my next video in depth. So oil is really interesting now as a short and a long kind of. That's tricky, really tricky, the oil stuff. And the tankers are relative to the oil thing. We gotta see if we're bullish or not in general. If we get bullish, I'll be crazy bullish on oil tankers and on gold. But right now, I'm not in either one at all. I have no exposure to either one. And short tech, XLK, and maybe industrials. Industrials are up really high, but they're not looking bearish. So it's kind of hard to know what to do with the industrials. But the XLK is looking bearish, and so I guess inside the XLK, I like shorting the ETFs themselves because they just have all kinds of extra kind of risk and stuff built in where they can actually get lower than the underlying assets. But inside the XLK, like there's Dell that has a really bad balance sheet, and I have Dell shorts specifically, and I have the XLK shorts in general. And then right now, PayPal is the highest stock inside the XLK, and I think that has the most downside risk right now for just the distance that it could fall as far as a specific stock inside the XLK. And then industrials like QQQ or like Nasdaq, Tesla stuff. That stuff is all, I don't know. I could do videos on those, but those aren't quite ripping as hard. Financials are like the XLF are down already, and all this credit contraction and then potentially negative interest rates are terrible for financials. Negative interest rates would be devastating for the financials. But Jerome Powell's coming out, master of psychology, Jerome Powell comes out and says the Fed's not going to do negative rates, and they've really tried this before and they were able to do it. And so the Fed's main tool, if you talk to Jeff Snider, is just a press release. They just announce like this is the interest rate and we're setting it here, and then people just believe them and try to trade at that interest rate, even if the market is kind of going in a different direction. And then finally, when the market pulls the interest rate in a different direction, they're like, oh, okay, well, we'll announce that it's here. And like if they see it trending up, they'll be like, okay, we're gonna be raising interest rates for a while here, and that's what they announced, whatever, like a year ago when they were going up. Like, yeah, we'll be raising rates, and then the market starts pulling them down, and they're like, we're gonna hold it right here, and then they crash down, and they're like, emergency rate, whatever. They're not controlling those interest rates. They're just announcing where they are trading, and right now they're trading right around zero, and they could go negative. But the Fed will announce zero. I expect them to try to keep it at zero with psychology and also open market operations. And they'll get a little extra crazy with the balance sheet, trying to keep it above zero. But as the world reserve currency, it's not the same thing as Europe going to negative interest rates. Like Europe can go to negative interest rates against the dollar because the dollar is the world reserve currency that had positive interest rates. But if the actual reserve currency interest rates go to negative, like that's a completely different thing. But it does make it really easy for them to create a ton of liquidity at negative interest rates, which could cause inflation, which would drive stock market's about to start trading. So let me get this video up. I don't want to get too crazy, but if they're able to get inflation, which they're trying to get some inflation right now against this credit contraction, that'll push the interest rates back up above zero on its own. And so I don't think the negative interest rates are long term particularly scary. as the world reserve currency. But I do think that the short term looks really bad for the financials like the XLF, but they're already down, and yeah, that's a short idea for sure. Like that's something that does bad in this type of cycle. Tech does bad in this type of cycle. Usually industrials do bad in this type of cycle, but they're not this time. And energy for sure, man. Oil, energy absolutely crashed already. And that's a tricky one. So those are the sectors I like to short in this type of cycle, and I have plenty of short exposure right now. So I don't really need more short exposure. I'm just kind of trading around with this thing and looking for bounces, and I'll keep you updated on where the bounces are and the whatever. Not much news at the moment. If we get anything else breaking, I'll put it out. Let me know what kind of videos you like. Please hit the like button to help me out with the YouTube algorithm, and starting a chat in the comments is really the best way to help this channel out. If you want to help the channel grow so we can get more content out. And yeah, I think that probably does it for this one. And hopefully this internet connection, I can get this thing up fast enough to, well, it's not going to be up at open because it's almost open now, but get this up as fast as I can. And not investment advice. Happy trading.